Something extraordinary is happening in the gold markets right now, and most investors have absolutely no idea what it means for their wealth. For the first time in over 50 years, gold is moving independently of the US dollar in ways that are rewriting the fundamental rules of precious metals investing. If you've been following gold for any length of time, you know the iron law that has governed this market since 1971. When the dollar strengthens, gold falls. When the dollar weakens, gold rises. It's been as predictable as gravity. Currency traders have built entire careers on this relationship. Central banks have structured their reserve strategies around it. Your financial advisor probably still believes it's an unbreakable law of nature. But something changed in late 2024, and it's accelerating into 2025 in ways that are catching even the most sophisticated institutional investors completely off guard. Let me show you exactly what's happening, why it matters, and what it means for anyone holding significant wealth in traditional assets. The first signs appeared in October 2024, but most people missed them entirely. Gold began showing unusual strength, even when the dollar was rallying. Not just for a few hours or a single trading session, but consistently, day after day, week after week. By November 2024, something unprecedented happened. Gold prices climbed above $4,000 per ounce, while the US dollar was simultaneously strengthening against major currencies. Under the old correlation model, this should have been impossible. When the dollar strengthens, gold is supposed to become more expensive for holders of other currencies, reducing demand and pushing prices lower. Instead, we saw the opposite. Gold surged to record highs, while the dollar gained ground against the euro, yen, and pound. The traditional inverse correlation that had held for decades simply stopped working. The financial media tried to explain it away as a temporary anomaly. Market volatility, they said. Temporary dislocation. Normal market fluctuations. But as we moved into 2025, it became clear that something fundamental had shifted in the global monetary system. What we're witnessing isn't just a breakdown in correlation. It's the emergence of an entirely new dynamic that's being driven by forces most people don't even know exist. The story begins with a quiet revolution that's been building in central bank vaults around the world. While most investors were focused on stock market rallies and cryptocurrency speculation, central banks were making the largest coordinated move into gold in modern history. The numbers are staggering. In 2024, central banks purchased over 1,400 tons of gold, shattering all previous records. But here's what makes this different from previous buying cycles. These weren't small, developing nations making symbolic purchases. These were major economies making strategic moves that signal a fundamental shift in how they view the global monetary system. The People's Bank of China led the charge, but they did something unprecedented in November 2024. They stopped reporting their gold purchases. Not because they stopped buying, but because they didn't want to telegraph to markets just how aggressively they were accumulating. Intelligence sources suggest China's actual purchases may have exceeded 500 tons in 2024 alone, making them the largest single buyer of gold in recorded history. Every ounce they purchased was removed from the global supply available to Western markets, creating a supply shortage that most investors still don't understand. But China wasn't alone. The Reserve Bank of India purchased over 200 tons. The Central Bank of Russia, despite being under the most comprehensive sanctions regime in modern history, managed to acquire 150 tons through intermediaries and alternative payment systems. Even traditional Western allies were quietly building their gold reserves. The Swiss National Bank, known for its conservative approach, added 80 tons to their reserves. The Bank of England increased its gold holdings for the first time in over a decade. Even the Bundesbank, Germany's central bank, made moves that would have been unthinkable just a few years ago. But here's the part that should concern every American watching this unfold. These central banks weren't just buying gold as a hedge against inflation or currency volatility. They were buying gold as a hedge against the US dollar itself. The catalyst was a series of events that most people never heard about, involving meetings that took place in nondescript conference rooms in Beijing, Moscow, and Dubai throughout 2024. Representatives from over 20 countries gathered for what were officially called routine monetary policy discussions. But according to sources who were present, what actually happened was the most significant challenge to dollar dominance since the Bretton Woods system collapsed in 1971. The Chinese delegation presented detailed analysis, showing how dollar-denominated trade was becoming increasingly risky for emerging economies. Not because of economic fundamentals, but because of weaponization. Every time the U.S. imposed sanctions, froze assets, or restricted access to the SWIFT payment system, it sent a clear message. Holding dollars means accepting American foreign policy, whether you agree with it or not. Brazil's central bank governor was reportedly blunt in his assessment. We're tired of having our monetary policy dictated by Washington's geopolitical agenda. Russia's representative, participating virtually due to sanctions, shared data showing how their economy had not only survived being cut off from dollar-based systems, but had actually strengthened by developing alternatives. But they weren't just complaining. They were implementing solutions. Within weeks of these meetings, something remarkable happened. A new gold-backed trade settlement system went live. Not theoretical, not experimental, fully operational, with the infrastructure to handle billions of dollars in transactions. The first transaction was modest, $50 million worth of oil from Iran to China, settled using physical gold as the medium of exchange. But it proved the concept worked. More importantly, it proved the infrastructure existed to scale it up rapidly. By December 2024, daily volume through this system had reached $2 billion. By January 2025, we were seeing single-day settlements exceeding $8 billion, and every single one of these transactions represented demand for gold that had nothing to do with the dollar's strength or weakness. This is the real reason gold has decoupled from the dollar. For the first time since 1971, there's massive, systematic demand for gold that exists completely outside the dollar-based financial system. Gold isn't just a hedge against dollar weakness anymore. It's becoming the foundation of an entirely parallel monetary system that's designed to operate independently of Western financial infrastructure. The implications are staggering, and they're accelerating faster than most people realize. Consider what happened to Turkey in late 2024. Facing pressure from both the U.S. and European Union over their foreign policy positions, Turkey's central bank made a stunning announcement. They were converting 40% of their foreign reserves from dollars and euros into physical gold. Not gold ETFs, not gold certificates, not gold futures contracts. Physical gold, stored in vaults in Istanbul, completely outside the reach of Western sanctions or asset freezes. Within 72 hours, 3 other countries announced similar moves. Kazakhstan converted $12 billion in reserves to gold. Malaysia announced an $8 billion conversion. Even Poland, a NATO ally, quietly moved $6 billion from dollars to gold, citing monetary sovereignty concerns. Each of these moves created gold demand that was completely independent of dollar movements. In fact, several of these massive purchases happened on days when the dollar was strengthening against other major currencies, which should have suppressed gold prices under the traditional correlation model. But there's an even deeper layer to this story that most analysts are missing entirely. The physical gold market is experiencing something unprecedented, a supply shortage that's being masked by paper gold trading on exchanges like COMEX and LBMA. Here's what's happening behind the scenes. The major gold dealers who provide liquidity to these exchanges are running dangerously low on physical inventory. Not because mining production has declined, but because demand from central banks and sovereign wealth funds has exploded beyond anything they've ever seen. Annual gold mining production is approximately 3,000 tons. Central bank demand alone consumed nearly half of that production in 2024. Add in jewelry demand from Asia, industrial demand for electronics and technology, and private investment demand, and you have a supply deficit that's being filled by drawing down existing stockpiles. But those stockpiles aren't infinite, and when they're exhausted, the price discovery mechanism is going to break in spectacular fashion. The COMEX futures market, where most gold price discovery happens, is built on the assumption that only a tiny fraction of contracts will ever demand physical delivery. It's a fractional reserve system, just like banking. For every ounce of physical gold in COMEX warehouses, there are typically 100 to 200 ounces worth of paper contracts outstanding. This works fine when demand is predictable, and most traders are just speculating on price movements. But when sovereign nations start demanding physical delivery in massive quantities, the system breaks down. In late 2024, something unprecedented happened. Physical delivery demands on COMEX exceeded available inventory for several consecutive days. The exchange had to implement emergency measures, including cash settlements for contracts that should have been settled in physical gold. Most traders didn't even notice because it was handled quietly, behind the scenes. But it was a warning shot. The paper gold market is becoming disconnected from the physical gold market, and when that disconnect becomes obvious to everyone, the price explosion will be unlike anything we've seen in modern financial history. Now, if you're sitting on retirement accounts worth $100,000 or more, this situation creates both enormous risk and enormous opportunity. I've put together a comprehensive guide on how gold IRAs work, including the mechanics of getting physical gold into your retirement accounts without tax penalties. You'll find it in the description below. It covers the tax implications, the practical steps, and the specific considerations for protecting retirement savings with physical precious metals. Worth checking out if this applies to your situation. But let's get back to the bigger picture, because what's happening with gold is just one piece of a much larger puzzle that's reshaping the global financial system. The dollar's role as the global reserve currency has been the foundation of American economic dominance for over 50 years. It's allowed the U.S. to run massive trade deficits, finance enormous government spending, and export inflation to the rest of the world. But that system only works as long as everyone else is willing to play along. And increasingly, they're not. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been joined by over a dozen other countries in developing alternatives to dollar-based trade. But it's not just about creating a new currency. It's about creating an entirely new financial architecture that doesn't depend on Western institutions. The gold-backed settlement system I mentioned earlier is just one component. There's also a new international payments system that bypasses SWIFT, a new trade financing mechanism that doesn't require dollar liquidity, and a new commodity exchange that prices everything in gold rather than dollars. Each of these systems is designed to work independently of Western financial infrastructure, and they're not theoretical anymore. They're operational, they're growing, and they're attracting participants at an accelerating pace. Consider what happened in the oil markets in late 2024. Saudi Arabia, America's most important Middle Eastern ally, conducted its first oil transaction using the new gold-backed settlement system. The buyer was India, and the transaction was worth $500 million. This might seem like a small amount in the context of global oil trade, but it represents something much more significant. Proof that even America's closest allies are preparing for a post-dollar world. The Saudis have been the cornerstone of the petrodollar system since 1974. Their agreement to price oil exclusively in dollars and to recycle their oil revenues through U.S. financial markets has been crucial to maintaining dollar dominance. If Saudi Arabia is experimenting with alternatives, it signals that they see fundamental changes coming. And they're not wrong to be concerned. The U.S. government's debt situation has reached levels that would have been considered impossible just a decade ago. Total federal debt now exceeds $35 trillion, and it's growing by over $2 trillion every year. The interest payments alone are approaching $1.5 trillion annually. This creates a mathematical impossibility. The U.S. cannot continue running multi-trillion-dollar deficits indefinitely without eventually destroying the value of the dollar. And foreign creditors are starting to realize that holding dollars means accepting the risk of being paid back in devalued currency. China has already reduced their holdings of U.S. Treasury securities by over $400 billion in the past 2 years. Japan, traditionally the most reliable buyer of U.S. debt, has reduced their holdings by $200 billion. Even European allies are quietly diversifying away from dollar-denominated assets. This creates a feedback loop that accelerates the entire process. As foreign demand for dollars decreases, the Federal Reserve has to print more dollars to finance government spending. As more dollars are printed, the incentive for foreign countries to find alternatives increases. And as alternatives become more viable, the demand for dollars decreases further. Gold sits at the center of this dynamic because it's the one asset that can't be printed, can't be manipulated by any single government, and has maintained its value across thousands of years of human history. But here's what most people don't understand about the current situation. We're not just seeing a gradual shift away from the dollar. We're seeing the early stages of a monetary reset that could happen much faster than anyone expects. The trigger could be any number of events. A major bank failure that exposes the fragility of the fractional reserve system. A geopolitical crisis that accelerates the move away from dollar-based trade. A debt crisis that forces the Federal Reserve to choose between saving the government and saving the currency. When that trigger event happens, the repricing of gold won't be gradual. It will be sudden, dramatic, and irreversible. Look at what happened in 1971 when Nixon closed the gold window. Gold was trading at $35 an ounce on August 15, 1971. By December 1974, it had reached $195 an ounce. That's a 457% increase in just over 3 years. But that was a partial monetary reset, affecting only the US dollar's relationship to gold. What we're potentially facing now is a complete reset of the global monetary system, affecting every major currency simultaneously. The mathematical implications are staggering. If gold were to resume its historical role as the foundation of the international monetary system, its price would need to rise to levels that most people consider impossible. Consider this calculation. The total value of all above-ground gold is approximately $15 trillion at current prices. The total value of global financial assets, including stocks, bonds, and bank deposits, exceeds $500 trillion. If even 5% of those financial assets were to seek refuge in gold during a monetary crisis, it would require gold prices to rise by more than 150% just to accommodate the demand. But that assumes an orderly transition, which is unlikely. Monetary resets tend to be chaotic, driven by panic rather than rational planning. In such scenarios, gold prices can overshoot fundamental values by enormous margins. During the 1979-1980 gold bull market, gold rose from $200 to $850 in just 18 months. That was during a period of high inflation but relative monetary stability. What we're potentially facing now is much more severe: a complete loss of confidence in the fiat currency system itself. The signs are already visible for those who know where to look. Physical gold premiums, the amount buyers pay above the spot price for actual metal, have been rising steadily throughout 2024 and into 2025. In some markets, premiums have reached levels not seen since the 2008 financial crisis. Coin dealers are reporting unprecedented demand from retail investors, but more importantly, they're reporting supply shortages that are becoming increasingly difficult to manage. The U.S. Mint has been rationing Gold Eagle sales to authorized dealers. The Royal Canadian Mint has extended delivery times for gold maple leafs to 10-14 weeks. These aren't temporary supply chain disruptions. These are symptoms of a fundamental imbalance between supply and demand that's getting worse, not better. The wealthy and well-connected are already positioning themselves for what's coming. Family offices, the investment firms that manage money for ultra-high net worth individuals, have been quietly increasing their gold allocations throughout 2024 and into 2025. Hedge funds that specialize in macro investing have been building massive positions in gold and gold mining stocks. Even more telling, central banks in Western countries are starting to follow the lead of their Eastern counterparts. The Bank of England increased its gold reserves significantly in 2024. The Bundesbank, Germany's central bank, has been quietly repatriating gold from storage facilities in New York and Paris, citing monetary sovereignty concerns. These moves aren't happening because central bankers suddenly became gold enthusiasts. They're happening because central bankers understand better than anyone else how fragile the current system has become. The derivatives markets, which dwarf the underlying physical markets by factors of hundreds or thousands, are showing signs of extreme stress. The notional value of gold derivatives outstanding exceeds $25 trillion, but the total value of all physical gold is only $15 trillion. This means the paper gold market is significantly larger than the physical gold market, which creates enormous potential for price distortions when the two markets diverge. And they are diverging. Physical gold is becoming increasingly scarce and expensive, while paper gold continues to trade based on financial market dynamics that have little to do with physical supply and demand. This divergence creates arbitrage opportunities that sophisticated investors are already exploiting. They're buying physical gold and selling paper gold, profiting from the spread while accumulating real assets. But this strategy only works as long as the paper gold market maintains some connection to physical reality. When that connection breaks, which could happen suddenly and without warning, the repricing will be violent and one-directional. The geopolitical implications of gold's decoupling from the dollar extend far beyond financial markets. For 70 years, America's ability to print the world's reserve currency has been the foundation of its global influence. Countries that wanted to participate in international trade had no choice but to accumulate dollars, which gave the U.S. enormous leverage over their domestic and foreign policies. That leverage is disappearing. Countries that can conduct trade using gold-backed settlement systems don't need to hold dollars. Countries that don't need to hold dollars can't be controlled through financial sanctions. Countries that can't be controlled through financial sanctions are free to pursue independent foreign policies. This is why the decoupling of gold from the dollar represents much more than a financial market phenomenon. It represents a fundamental shift in global power dynamics that will reshape international relations for decades to come. The speed at which this transition is happening is unprecedented in modern history. Previous monetary transitions, like the shift from the gold standard to the Bretton Woods system, or from Bretton Woods to the current fiat system, took years or even decades to complete. But we're living in an age of accelerated change, where information travels instantly and capital can move around the world in milliseconds. What might have taken decades in the past could happen in months or even weeks today. The infrastructure for a post-dollar world already exists. The technology for gold-backed digital currencies is operational. The political will for monetary independence is growing stronger every day. The only question is, what will trigger the final phase of the transition? It could be a major bank failure that exposes the fragility of the fractional reserve system. It could be a sovereign debt crisis that forces a major economy to choose between default and hyperinflation. It could be a geopolitical event that accelerates the formation of competing monetary blocs. Or it could be something as simple as a critical mass of countries deciding that the benefits of the current system no longer outweigh the costs. Whatever the trigger, the outcome is becoming increasingly predictable. Gold will continue to decouple from the dollar because the fundamental drivers of that decoupling are getting stronger, not weaker. Central banks will continue accumulating gold because they understand that monetary sovereignty requires monetary independence. Sovereign wealth funds will continue diversifying away from dollar-denominated assets because they recognize that concentration risk is becoming unacceptable. Private investors will continue seeking alternatives to fiat currencies because they can see the mathematical impossibility of the current debt trajectory. And as each of these trends accelerates, the others accelerate as well, creating a feedback loop that becomes self-reinforcing. The question isn't whether this transition will happen. The question is how quickly it will happen, and whether you'll be positioned to benefit from it or be devastated by it. History shows us that monetary transitions create enormous wealth for those who position themselves correctly and destroy the wealth of those who don't. The shift from the classical gold standard to the Bretton Woods system created fortunes for investors who understood what was happening. The collapse of Bretton Woods created even larger fortunes for those who positioned themselves in gold before the repricing occurred. What we're witnessing now has the potential to be the largest wealth transfer in human history. Not because wealth is being created or destroyed, but because it's being repriced according to new monetary realities. Those who understand what's happening and position themselves accordingly will see their wealth multiply. Those who remain trapped in the old paradigm will watch their purchasing power evaporate as the currencies they're holding lose their privileged status in the global financial system. The decoupling of gold from the dollar isn't just a financial market curiosity. It's the beginning of the end of the monetary system that has dominated the world for the past 50 years. And like all major historical transitions, it will create winners and losers on a scale that most people can't even imagine. The choice is yours. You can continue believing that the old rules still apply, that the correlations that worked for decades will continue working forever, that the institutions that have managed the global financial system will somehow find a way to maintain their control indefinitely. Or you can recognize that we're living through one of the most significant monetary transitions in human history, and position yourself accordingly. The signs are all there for those willing to see them. Gold has decoupled from the dollar for the first time in over 50 years. Central banks are accumulating gold at record pace. Alternative payment systems are becoming operational. The mathematical impossibility of current debt levels is becoming undeniable. The transition has already begun. The only question is whether you'll be ready for what comes next.